All right, founders, it is time for another pitch deck critique and review. And in this deck, I have a surprise for you. By the end of the deck, stick around and you're going to see the surprise has to do with the name. You might already know a little bit what this surprise is if you've been hanging around my channel for any amount of time. The question with this pitch deck: are we talking about a fintech here? That is an interesting question we need to look at. And this founder, I believe, could raise about 500K, but is choosing to seed strap. And it's an important conversation that I had with this founder. So if you are seed strapping or you want the option to go raise pre-seed money, about 500K, this is the type of pitch deck that we are looking for. And I'm going to show you all the different nuances that make this pitch deck, I think, very effective. And there's a reason for that as well. It's all part of the surprise. Before we continue, if you want your own pitch deck critiqued and reviewed, stay till the end of the video. I have instructions for you. And my name is Ed Kang. If we've met before, skip to the chapter marker to start the video. I made it as easy as possible for you. You are welcome. If we haven't met before, welcome to my YouTube channel. I'm a 7-time funded founder with 2 X's. That's just a fancy way of saying I failed a bunch of times to your benefit, because I use videos like this to help founders, especially early stage founders, if you're raising early stage funding, avoid some of the catastrophic mistakes that I've made during my career. Not to say you're not going to make mistakes, but I'm going to try to make your life a little bit easier because it's hard enough as it is. I'm also the Chief Strategy Officer for Startups.com. If you haven't checked us out yet, go to Startups.com. A lot of free resources there. If you are part of Startups.com, thank you so much for being part of the community. While you're here, like, comment, subscribe. Let me know what you think. Appreciate all the interaction, all the feedback, and your support. Let's jump into this pitch deck critique and review. By the way, if you look at the cover slide, we've got one sentence that explains what the startup is. It is a proprietary trading platform. This is what's leading us into the fintech territory. But then here is included a purpose statement. And I'm always about being clear and concise over being clever. And so you don't want to put anything in terms of buzz or marketing hype here. You don't want that. But if you have a strong purpose statement that clearly explains what you do, then that is okay. And that's what we have here: empowering day traders to trade profitably with the support of executive coaching and performance psychology. The reason we do this on title slides is so that the investor knows exactly what they're getting into, and that's what we've achieved with this slide. Here's a problem statement. Over 2 million US day traders lose a combined $20 billion a year, not because they lack skill or strategy, but because they lack the emotional regulation needed to manage risk, discipline, and stress under pressure. Remember, in every single problem slide, you want to have who has the issue and then explain the size, scope, and severity of the problem. The severity is what happens, what it costs in dollars, hopefully, if you do not solve the problem. So let's talk about who and the size of the problem. We have 2 million day traders, and the scope is here. They don't lack skill or strategy. That is what everybody else provides, but they lack the emotional regulation needed to be profitable. And that's the scope. What's the severity? Well, it equates to $20 billion in losses per year. There's actually research out there that estimates that because of these emotional decisions, day traders will lose $10,000 a year on average. Notice how the problem slide is one stark summary sentence up at the top. There are no bullets. It's just straightforward. And then ChatGPT did a nice little image explaining or demonstrating, visually representing the problem. Let me just state this clearly. If your problem slide is more than one sentence long, and that sentence is more than 30 to 40 words, then it's got too much going on in it. You just want to hit the investor with this is the problem, make it stark, and make them decide, hey, I'm interested in this problem or I'm not. But they have to understand it. Therefore, you have to be clear and concise. You don't have to jam your slide up with all this information, all these different points, state of the market, and all these stats. You don't have to do that. This is the introduction. It is like the headline, the ad for the ad. Just start very simple and hit them with it. Here's the solution slide. We're building a proprietary trading platform that connects retail day traders with executive coaches to unlock performance, reduce emotional mistakes, and profit together through real-time mindset, risk, and support. So in a solution slide, you basically want to explain what the problem is, how it solves the problem, specifically how it addresses the scope, and you want to explain any differences, any special sauce, any results that you can promise that really set your solution apart. In this case, what the solution is, it's a proprietary trading platform, And how it addresses it, it connects retail day traders with executive coaches. That's new and novel. And the difference is we're going to do coaching with mindset and risk management support, and we're increasing performance because we are connecting traders with executive coaches. You don't need to have a step-by-step. You don't have to explain it. You don't have to go into detail. Just give them the one summary sentence that explains what it does, but make sure that you address the scope. Remember, I always say this. If you're saying the problem is slow, manual, and expensive, then you have to say your solution is fast, automated, and 10 times cheaper. You want to go back and you want to literally reverse engineer and solve the problem step by step, which is what this pitch deck did. Here's the market slide. There are 2 million day traders losing money in the US. We've established this. We will first target the 500,000 traders that are motivated, coachable, have some capital, and actively want to improve scale, representing a $1.2 billion opportunity. This TAM is bottom up. Most of you do top down. You say cybersecurity is a $3 trillion industry. Market is calculated here. If you do TAM, SAM, SOM, you show your math. The market says there are 2 million US day traders, and we're going to charge $200 a month. That's what this startup does. The SAM, which is where you're going to focus because of some type of advantage or business model, that's what you want to do. Or you can even add a strategic insight. So if you have this insight and you say, okay, this is what is going to help us really establish that beachhead, and you're going to be able to start here but expand into the TAM. Well, it's 500,000 day traders that are motivated and coachable. We're saying that we're going to find out, this startup is going to find out of 2 million, how many of them are actually coachable because it fits the business model of executive coaching. Remember, the solution is coaching, so we want to make sure that they're coachable. They think this is a good idea. And this startup projects that's $500,000 times $200 a month. That's a $1.2 billion opportunity. The SOM here is interesting for me because they're saying 15,000 US day traders. That's what we realistically can do in 5 years. If everything goes right at $200 a month, that's $36 million. It's not $100 million. And this is where we have to discuss the distinction. If you're trying to pitch VC, you have to have over $100 million in your SOM. Why is that? Because a unicorn is $100 million in revenue at a 10x valuation pre-IPO, pre-going public. In this case, the founder is pitching, saying, it's just going to get to $36 million. This is what realistically this single founder could do. VCs are not going to be interested in it unless they are interested in seed strapping. And that's the reason I saw this and I said, wow, this is a deck, a startup that is a candidate for seed strapping, because the way it's put together, from what I understand, $36 million, everybody makes a ton of money. And you could technically exit for maybe 50, 75, maybe $100 million. And if you seed strap, then that's perfectly okay because you don't have to share all this revenue with your cap table. You're not diluted. The founder makes a lot of money and the initial seed investors make a lot of money. The lion's share, it's perfect for seed strapping. So you might have one of these startups where it's like, I don't really want to get to $100 million a year revenue, but I can get to 10, 20, $30 million and you'll be just okay. Well, seed strapping may be for you. Now let's take a look at how it works. And it's very simple. Stark headline up at the top. Every trader is assigned an executive coach and shares their profit with them. That's literally explaining how this is going to work. But now this pitch deck is broken up into 3 steps. Step 1, this is basically the user's experience, because that's what the investor wants to know. How is the user going to go from start to finish and have that fairy tale ending that you're promising? So step 1, screening, onboarding. Step 2, evaluation stage. And step 3, trade a live account. And there's just a brief description. It is not an instruction manual. And then there's a little highlight at the bottom. Every trader has access to knowledge library, chat rooms, daily group coaching, and one-on-one sessions as needed. It's so straightforward, 3 steps. If you can't explain your startup and how it works for the end customer without being totally obvious, you don't want to say user shows up to the website, logs in, creates an account. Yeah, we all know that. But you want to explain how the special sauce works in as little pieces or steps as possible. I would say a maximum 5 steps, but your descriptions better be extremely brief. But there can be lots of time later for the investor to ask questions like, how do payouts work? How does onboarding work specifically? What are you going to ask on your questionnaire? What if this happens? What are your contingencies, liabilities? Fine. But you want to get them into that conversation and say, I can explain it 1, 2, 3, because why? The investor thinks in their mind, you're going to be able to pitch customers and other investors, other stakeholders in the simplest way possible possible. I like what this founder is doing in making it as simple as possible. Now let's go to the business model. It's pretty much how you make money. You have your summary sentence. Just tell us, we plan to charge $100 to $300 a month per account. That's how we got to the TAM of averaging $200 a month. All profits are split 80-20 between traders and coaches. That gives you a bit of idea in terms of margin. We have a graphic over here, and then we have future revenue opportunities. You don't have to explain this. You can just say, hey, these are the potential future revenue opportunities. Training camps, institutional clients, rebates, affiliate revenue, licensing, and coaching model. But it's pretty straightforward. In the beginning, this is how we're going to charge. Allows the investor to investigate, think about the business model and the future. But Ed, you might be saying, I've got so many ways I'm going to generate revenue. The more ways that you have to generate revenue, the more complicated your business is going to be, and the more the investor is going to wonder, are you able to pull it off? So you want to start, just like your marketing, with a beachhead and saying, our revenue model is simple. We're going to charge $200 a month. Now, in the future, we don't want to be a one-trick pony. We want to expand. Therefore, we're going to add all these other revenue streams. And if the investor wants to have conversations and say, well, what does this licensing model look like? You go back to, it could look like this. We've thought it through. But right now, the foundation is we're going to start with this revenue model. That's how you balance between being practical right now in the short term and long term. This is our vision, and we could be massive unicorn because we got all these generalized, expanded, diverse revenue streams, which every startup has to do. So when you go public, that's what public investors want to see. Look at Google, became search engines all the way to Alphabet, and now they got all these lines of business, and that's fine. You can do that in the future, but start right now by convincing the investor we will dominate this one market with this one revenue stream and make the money and show you we can execute and then expand from there. Here is the go-to-market strategy. Once again, summary sentence right at the top. We'll use content marketing such as YouTube channels to attract aspiring day traders and build online communities. And illustrated a process, a funnel. Basically, you start off with YouTube. I like this strategy. You're going to see why. Obviously, if you're on YouTube, you understand why. And then it's going to go to free webinars and then a free coaching trial. There's the funnel right there. And then it's got a little bit of traction metrics showing that this startup understands how to do YouTube marketing. We have proven experience driving traffic on YouTube, actual metrics. So now the investor goes, there is proof. There's social proof. There's evidence. There's hard metrics. And therefore, you're de-risking the investment. Notice how this is not a slide filled with a laundry list of tactics that you're just going to say. It actually says a strategy. Most founders make the mistake of putting that laundry list together and say, we're going to do Facebook and we're going to go viral. We're going to pay for ads. Social media, that's what we're going to do. That doesn't make sense because anybody can do that. You're basically telling the investor, just give us some money. We're going to try some stuff. Tell them how you are going to try to learn if you're in that early stage, or give them evidence. Hopefully you've gone out and battle tested your assumptions and said, we've learned by doing this, this is how we can get customers. And later on, you can include customer acquisition costs and lifetime value and churn rates. I have a founder right now that said, we got our first customer by scraping the internet and sending them handwritten notes. I said, great, tell the investor you're going to keep doing that, and this is what you project. Don't tell them all these other things that you don't know whether they're going to work. Maybe you can say, in the future, we might expand to this, but right now we've learned that this is working. Therefore, we're going to double down on it, and you know your money is going to be used in a predictable fashion. So if you want a great go-to-market slide, test your tactics, your assumptions first, and then put them in your go-to-market strategy. Let's look at the competition. This is a straightforward quadrant model. I like quadrant models if they work. You can also use a features and benefits matrix, something that basically looks like this, where you got your competition up at the top and you've got a grid and you've got check marks and boxes and X's saying that, okay, this is where we're different. But look at this summary sentence up at the top. The competition prioritizes scale with shallow pre-recorded content while we offer the certified executive coaching, proven techniques, and real community support built for retail traders. Desk firms are highly selective. So they're distinguishing with retail traders. And notice the quadrant. It is not, this is bad and this is good. It is not that. Quadrant models are not built that way. So take this out. What you're saying is this is what customers want and this is how our competitors deliver. So we can say here, retail accessible, challenge-based. That's what this company offers, right? But so do these other companies. And so we're not saying, oh, all these other companies are bad. What we're saying now is there's another dimension, customized, personalized coaching and structured pre-recorded coaching. Neither is good or bad. We're saying that this is superior, but there are other companies as well that offer this. So we've got on this other side, professional desk-based where they're selective, and these companies do offer executive coaching, but not for the retail trader. And here we've got, all right, professional desk-based, but you have to get in, you have to be selected, but it's structured pre-recorded training. So we're saying all these companies are good and they all make money, and they do. Some were shut down for regulatory reasons, as I did the research, but here we are distinct and unique, and couldn't find any other company that offered this. Maybe we're missing something, and I'll have to do some more research, but right now it clearly shows this is how we're going to differentiate from the market. Now we made it to the team slide, and this is where the surprise is. I am an investor and an advisor in this company. I'm also pretty much like a standing co-founder. But the reason for this is because we are seed strapping, and you want strategic investors who can help you get to the point where you never need to raise funding other than to grow, and you only have to raise one round and never again. So I'm here to push the seed strapping. If you look at this description, and I'll explain why I joined this startup and why I invested. Not a big amount, an angel check to get things going. It says here, our founders met over 30 years ago. I know the founder, shared one successful startup exit. I've done that with this founder, and have a career experiencing day trading and certified executive coaching. So this one founder brings the day trading, and then I bring the executive coaching. This founder, who is a friend of mine and longtime partner, came to me and said, I have this idea. I've been doing some research, and he pitched me verbally. And I said, that's a really compelling idea. It was compelling because I could see myself not only investing money into this, but the amount of money that I invested could be stretched a lot farther for strategic value than just writing a check. If an investor can answer the question, why me? Why the investor? Not why you, the founder, why me as the investor? I could make this thing pop. They're going to be a lot more interested, and you basically have someone on your team that can help you seed strap. And we talked about how much revenue we want to reach before we make that decision. And here's how we made that decision. I asked the founder, how much money would you need to build the next version of this? Because I'm going to write the check and put in the money to do the first MVP, which we're using off-the-shelf software. We're using things out there already, pre-existing. We're not building anything yet, which I will show you what we're doing. I said, how much will it be to build something that we can say this is a product and maybe go raise more investors, but make money with? And he said to me $100,000 for base cost, but I'd have to be making money along the way because I'd have to stop doing the revenue generating opportunities and start building. I said, all right, so how about we do this? Let's go make $100,000 using this model of profit and then determine whether we want to raise money or not, or reinvest the $100,000 in, and now you got that covered, and we can continue making money. We'll figure out the model. We'll invest money so that somebody else can come in and help us build. Or we can say, you know what? We don't need the investment. We just like the money that we're making. Let's make that decision. Optionality. That is the word that you are looking for. If I can get to the point where I have options, I am not beholden to other investors. Because truth be told, I hope we never have to deal with another investor. I don't want to work with investors. I've been very clear on this channel. I've had good experiences, but I've had enough bad experiences to say, you know what? I'm at a point in my career where I don't need external investors. I will take investment. However, if it's going to pour gasoline on fire and there's a rocket ship ready to happen, we can scale and I can bring in other people's CEO. At that moment in time, I'm willing to reduce my equity stake down to single digits and I'm ready to get out. But at least we've given it a chance and we will have the options. One more time, optionality. We want those options later on, and that's what's made me agree to be part of this startup. Because startups that come to me and say, can you invest? And I need to go raise $10 million, or they don't have traction, they don't have that revenue. That's really tough for me to make that decision because I've got options myself in terms of revenue generating things. And you have to be thinking about this in terms of investors out there, especially in this investment funding climate. Angel investors, if you can show them not only can they contribute and help increase the value, but you're going to seed strap or you're going to generate at least revenue so they know that they're safe and that the risk is not the same as other startups where you have to invest and hope for 10 years to go by where you get a return on investment because there's some type of exit. Let the VCs handle that. If you are trying to raise angel money, you want to be thinking possibly in this other direction. I'm not poo-pooing VCs. Remember, seed strapping is not anti-VC. They have a place. If you're building that type of startup, then by all means, go raise that pre-seed round, then that seed and go A, B, C, D, go public and have at it. but that's not me. And therefore, that's not this startup. And that's the reason I got involved. Which brings us to our traction slide. And this is our initial test. And I'm very straightforward. We are at a very early stage, currently conducting an MVP with a third-party prop trading firm. The first milestone target is $100,000 in profit. Please contact us for performance. Here's what I did. I took this founder's pitch to me, and we put it into a slide deck format. And he gave me the problem solution, explained it all, gave me the competitive analysis. I got all this from the founder. Let me run with it. I put it into this pitch deck format, and I created a version of the idea validation deck, which is me going out to investors and show them. I may do it, I may not do it, but if an investor's interested, I'll say, here's what we're working on right now, and here's our initial MVP. Then I'm going to say, hey, let me know if you want more information, regular updates from our MVP, and I will continue to update this deck, and I'll continue to send them investor updates. I have it set up where this founder is sending me updates every Friday in terms of performance, and we meet once a week to figure out our traction, look at our metrics, have the meeting, and say, what do we need to start, stop, continue doing? And we're going to push that traction to 100K, and I'm going to evaluate how far we get there, and that's the sprint that we're on, and that's what's going to give investors confidence in the future and create that FOMO. Is it going to work? It could be a complete dud, but that's okay. At least I don't have investors breathing down my neck. I don't feel bad. I'm not beholden to their money. They haven't changed why I'm doing things. It's self-contained. I'm the angel investor, so we're basically bootstrapping. I can contribute, participate, and now we're going to go off, create that traction, but keep investors informed because you never know. It's better to have and not need than to need and not have, and that's how you play this game. Now, here's the final slide. This is my little special trick where I put funding is not required at this time. Contact us if you'd like to receive investor updates. This is optional. This is just something that I can do. I can do it myself because I have a track record. And I dangle it in front of them. I say, you know what? I don't need the funding right now because guess what? We're already funded internally. We're making money. But if you want to receive investor updates, I'm happy to do that for you. And I will take that seriously. If someone wants to throw me money and say, please take my money, I'll say, I can't do that right now because we're not exactly sure, but I'll let you know. Now, they may just say, I don't care, just take my money. And, maybe I'd consider it, depending how friendly they were, what type of investor. But I will say I'll keep you updated, and I will do it in earnest because once we get that inflection point and I say, hey, everybody, we made $100,000 in profit. We just hit that milestone. Here are the receipts. Then there's going to be FOMO and possibly a bidding war. And then I have that optionality to go to my partner and say, what about this investor, that investor? Let's meet them and let's interview them as much as they interview us. And then we've changed the power dynamic. It's reversed. We don't need them as much as they need us when what they try to do is say, you need us more than we need you. And that's not the game that I want to play when working with investors. You're raising money when you don't need money. Like I said, here's my warning. You have to be willing to play this game because I sent this deck through some analyzers and it says, why would you create a pitch deck if you don't need money and you say you don't need money in the end? What's the point of pitch deck? I said, that's what you don't understand, AI, that this is the way that you set it up to make your fundraise easier at a later date. But this is what we're all about here, and these are the types of pitch decks that I think are going to be successful. That's it for this one. If you want your own pitch deck critiqued and reviewed, leave a comment, and you have to explain what you're building. And then I will give you a return comment and tell you what the process is, and then we will go from there. I have to put in a process because we have so many people that want pitch decks critiqued and reviewed that I want to make it useful for the rest of the community, for us and for Startups.com. If you're part of Startups.com, you don't have to go through the same process. You will automatically get qualified to do one, and we're going to do that. So make sure that you let us know. But if you're not part of Startups.com, that's okay. We just want to make sure that you are clear and we have a learning experience so that if we do the pitch deck review for you, that everybody else in our community can benefit, because that's why we want to do this, for the larger startup ecosystem. Do it that way, and I'll make sure that we work together. Look forward to seeing what you send in. Watch some of the other videos that I'm going to put on the screen right now. This has been your pitch deck critique and review. I'll see you in the next one.